From New York City for our viewers worldwide, I'm Matt Miller in for Jonathan Ferro. We are looking at equity indexes doing a whole lot of nothing as we wait for the Fed tomorrow. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Coming up, markets on edge as the Fed kicks off its two-day policy meeting. Oil extending its rally with prices hitting a 10-month high, and the UAW preparing additional strikes unless serious progress is made by Friday at noon. We begin, though, with the big issue, surging oil threatening the soft landing.
We're seeing oil prices on the rise.
Higher oil prices matter a lot.
Oil is really important.
Higher energy prices are a major risk.
It's going to be problematic. Might affect consumer sentiments, and that should weaken the case for the soft landing. We're going to see this getting passed through, not just at the pump, but in transportation costs, delivery costs, input costs.
If oil prices go up, what does the Fed do?
The Fed is going to be paying very close attention to the path of energy prices ahead.
They are going to be cautious. If we're looking at an oil shock at 120 or something, significantly higher than today's levels, number one, I think that becomes a huge problem for the Fed.
If the OPEC Plus keeps on restricting supply, oil prices can go higher.
The price of oil is going to keep going up.
It could go above 100 in the next couple of weeks.
Whether we're going to have a true soft landing, rather a short and shallow recession, is still an open question.
Joining us now to discuss that open question, J.P. Morgan's Bob Michael and PGIM's Greg Peters. We are, gentlemen, continually asking over the past couple of weeks, or rather Ferro is, and I listen to him on surveillance, whether or not this rising oil prices and really rising rates is going to put an end to the soft landing narrative because it's engineered by OPEC, or is it a sign rather of demand and a growing economy? Bob, let me get your take first. What do you make of rising rates and the rising oil price?
Yeah, hi, Matt. I think this is certainly OPEC engineered. This is cost-push inflation. It's very dangerous for the consumer because a consumer which has tapped out their excess savings and put more on their credit card now has to face higher prices at the pump. And I don't know that they're prepared for that. It reminds me that over the decades, we've always looked at spikes in oil prices have preceded recessions. I think we may see the same thing again.
Greg, what do you think? Do spikes in oil prices and the end of hiking cycles precede recessions?
Well, it's a complicating factor, no doubt about it. I think the real challenge on the table is what can the Fed do about it? And I think the short answer is nothing. And so it's going to be very tricky, I think, for Powell and other central bankers to kind of include the oil narrative into the mix here. And so, Bob's quite right. It does put additional tax on consumers. But ultimately, will it complicate the Fed's mandate and whether they need to pause or continue to raise rates?
In terms of what we're seeing on oil, we spoke yesterday with the CEO of Chevron, Mike Wirth. Listen to what he had to say.
Sure looks like it. We're certainly moving in that direction. The momentum, supply is tightening. Inventories are drawing. These things happen gradually. You can see it building, and so I think the trends would suggest that we're certainly on our way. We're getting close.
It sure looks like it. We're on our way. What he means is to $100 barrels of oil. Greg, how complicating will it be if we get over that big round number?
Well, it's a confidence issue, right? And so we're in a very tenuous spot for the consumer. They've blown through their savings. Mortgage rates, interest rates are much higher. So there is a dampening effect here. And so is this the event that really kind of pushes them to kind of retrench and recede? I don't know. They've been incredibly resilient thus far. Just because they've been resilient doesn't mean they will be going forward, though, and I think that's the trick. So, this is yet another complicating factor for investors, for the economy, and for central bankers.
Bob, what do you think? I mean, does $100 oil. Does OPEC Plus work kind of hand in hand with the Fed to push us into a recession?
I don't think they're working hand in hand, but this does remind me a lot of the first half of 2008 when energy prices were going wildly higher, and we were sitting around a table saying, you know what, maybe the correct central bank response is to ease monetary policy, because in a rather frail economy with housing under pressure, the consumer can't take a spike in oil prices. And then magically in July, the ECB hiked rates, thus ensuring a recession. So I think this is a tricky one for the Fed. I would do nothing if I were them and just wait to see what happens over the next couple quarters.
All right. My use of the phrase hand in hand was meant, of course, tongue in cheek. We have just one day until we get the Fed decision. The meeting kicks off today. We get the decision, obviously, tomorrow. Bloomberg's Michael McKee joins us for more. So what do we get here, Mike? Is this a screaming hawkish pause, or is it just like an inside voice hawkish pause?
I think Bob gets what he's looking for in terms of the Fed doing nothing. Right now, we've got a 1% chance, less than a 1% chance, according to the financial markets, that the Fed raises rates. So then it becomes a question about what they say rather than what they do. And we get new economic forecasts that could tell us something about that. Look at the bottom line there, PCE inflation. If the Fed thinks that inflation is going to be lower than what they had forecast for the next 2 years, then you're probably going to be looking at an end to the tightening cycle, and it will raise questions about what they do next. How long do they need to keep rates at a high level, the higher for longer thing? The problem for the Fed is how much confidence can you have in your forecast given the huge list of potential problems out there? You're talking about oil prices. We got the student loan payments, UAW strike, government shutdown, the war that Russia's prosecuting in Ukraine, and China's economy. Also, health insurance costs expected to rise next year. So a lot to try to divine from what the Fed puts into their forecasts, into their statement, and what Jay Powell says. The goal, I guess, for the Fed is to try to limit what happens with the forecasts for rate cuts next year. They don't want the markets to get ahead of themselves. And right now, we are pricing in a significant number of cuts for 2024. The Fed will hope, I guess, that they keep those steady. Now, Matt, with your permission, it is tradition on this show that before the Fed meeting, Bob Michael tells me the question to ask Jay Powell, what he wants to know from the Fed chair. So Bob, what is it this time?
Well, I think, Mike, and thank you for asking, I've got loads of questions for the Fed, but I think the first one is we've always felt that a disinflationary trend towards their 2% target was a necessary ingredient for them to pause. We've had that. I want to know, what is their trigger to actually start cutting rates? Do they see inflation moderate and be somewhere in the low to mid twos, so the real Fed funds rate is actually over 3, so they start to ease into that to make sure that they don't accidentally tip things into recession? Or do they wait until unemployment goes up 0.5%, 0.75%, thereby ensuring that they're too late?
Actually, I was going to ask you, Mike, about that as well. You know, all of these concerns for the consumer, but I guess unemployment is the actual mandate, right? We're all watching inflation more closely than we're watching growth, but what does the labor market look like?
The labor market is still tight, which raises the question of, do we still see companies paying more to attract workers? And as long as that's the case, the concern at least, then the Fed is going to be cautious. But they do have the 2% target. I don't think we're going to get any kind of specifics like Bob's talking about, because they don't want to lock themselves in. We will probably get more something along the lines of the old Potter Stewart definition of pornography. Can't describe it, but I know it when I see it.
Wow, I thought that was C. Everett Koop. I want to ask Greg as well, while I point out that the Treasury 5-year yield is up to 4.5%, over 4.5%, the highest level since 2007. I'm looking at a 10-year yield at 4.3566, so that's up there at the highest level since 2007 as well. Greg, what would you ask the Fed? Give Mike some ammunition for his meeting in Washington tomorrow.
Well, you know, I think it's funny that, Bob's question, notwithstanding, I mean, you can ask any question you want, but, the problem is you never get an answer, and I think that's the frustrating part. But the aspect that I would really focus on is our star, the terminal dot, to really get a better understanding of whether they believe that the terminal rates are higher. And I think that gets you to, Matt, the question on the 5-year. I think the market is finally coming to the realization after fighting it for the past 9 months, 18 months, that rates are actually indeed higher here, and we're not going back to this pre-pandemic type of level. And ultimately, I think what will drive that behavior going forward from a rate perspective is that terminal value.
Mike McKee, everyone thinks this hiking cycle is done. I mean, a lot of people are saying they're going to hold and that'll be the last hike. Do you think Powell is going to keep that dot, that one more dot for this year, or is the Fed going to keep that dot in the plot?
My guess is that they do keep the dot in the plot because they want to retain the optionality. If they take it out and then decide they have to raise again, that would upset markets, I think, more than if they leave it in and don't do it. So I would expect that the dot remains.
All right, Mike McKee, go get on the Acela. Don't drive. I can recommend against that with this traffic. Unga is in town. Bob Michael and Greg Peters going to stick with us right now. I want to get to a look at what's going on in the stock market ahead of the opening bell. For that, we go to Abigail Doolittle.
Well, U.S. futures, Matt, right now are down just ever so slightly, and we have had some breaking news on Disney in the last few minutes. They have put out a filing. They are expanding their investments in parks. Now, what makes this very interesting recently, the big segment that everybody's talking about, of course, streaming, but their most profitable segment is parks. I think it's 60 to 65% of profitability, even though it's only 35% of revenue. $60 billion of capex in this segment. The stock is down 1.2%, but over the long run, especially as they look to divest their TV assets, this could be a positive move. Deere down 2.2%. Evercore has cut the shares to an in-line on risks to revenue, even as valuation is basically fine. And then Royal Caribbean, Truist has upgraded this stock to a buy. Carnival Corp to a hold. The analysts there saying forward-looking trends for 2024 and 2025 look exceptionally strong. The numbers are conservative. Those shares are higher, Matt.
All right, Abby, thanks very much. Abigail Doolittle there with a look at the equities market. We're going to see the open in just about 18 minutes' time. Coming up, the UAW is raising the stakes.
We're not waiting around, and we're not messing around. So noon on Friday, September 22nd, is a new deadline.
The latest developments in the U.S. auto workers strike. That conversation up next. This is Bloomberg.
We're not waiting around, and we're not messing around. So noon on Friday, September 22nd, is a new deadline. Either the big three get down to business and work with us to make progress in negotiations, or more locals will be called on to stand up and go out on strike.
That's the UAW setting a new deadline for Detroit's Big Three, warning that more of its members will go on strike unless substantial headway is made by noon this Friday. Time is of the essence for the automakers. S&P Global Mobility estimating that the walkout is already costing them output of roughly 3,200 vehicles a day. Bloomberg's David Welch joins us now from Detroit, where he is the bureau chief overseeing this action. David, what do you make of the latest warning? I know some car makers are already slipping into contingency plans for drawn-out strikes.
Oh, that's right, Matt. So, look, there's going to be a lot of war of words here, but I think what Sean Fain is upset about is the union has the last offer on the table. They haven't seen a counter from the companies. And you know, maybe the companies are looking at a different way to do this because everyone's been sort of bumping up the pay raises, 1% here, 1% here, and it hasn't gotten it done. So maybe they're taking a step back to figure out what else they can do to creatively make this work. I don't think they're going to want to go too much higher than the 21% where they already are, and you know, maybe 25 gets it done. They don't really know. But you know, at this point, there is work being done at the table. There are always negotiators there passing things back and forth, but you know, we haven't had a formal counteroffer from any of the companies since September 14th, and Fain is basically threatening another round of strikes to get them to come to the table with a new offer for him.
How long until this, or will this, David, have any effect on the supply chain for other automakers? I keep asking, I asked the CEO of Maserati yesterday, I asked the CEO of Mercedes. They aren't terribly concerned yet about indirect effects.
Yeah, and they wouldn't be just now because you have 3 plants that make a couple very specific models. That's not enough for parts plants to say, okay, we don't have enough work to keep going and start laying people off. You would probably need, if there are several assembly plants, maybe more, let's say 2 from each company in the second round of strikes. Then you start to have parts companies that are, they're really maybe hurting for volume for specific parts. But, if he does it this way, those companies can keep going for a while. So it's really a matter of how long this goes and also how quickly Shawn Fain decides to ramp up the walkouts. If it goes from 1 plant, as it was the first round, to 3 each in the second round, it just gets more dicey for the parts companies the more he adds on. We'll have to see how aggressive he gets come Friday if there isn't enough progress to avoid another strike.
All right, David Welch coming to us from the busiest bureau in America this week. He covers the autos, and they all do. Keith Naughton, Gabby Coppola, and the whole team. We'll continue to hear from them. Bob Michael and Greg Peters still with us, and I wonder what kind of effect this is going to have on the Fed's forward planning. Greg, how closely do you think they're watching this strike?
I think they are. I mean, it's another complicating factor. All we're talking about is complicating factors, right? So the Fed is looking at a myriad of different issues that influence their policy. But the strike has a twofold effect, right? One is the impact on the overall economy, of course, but then wages, right? And so one of the aspects that the Fed is really trying to weaken here is the labor market, and the wage gains is something that, complicates their mandate. So, I think this is a double hit for the Fed in many respects.
How strong do you think the labor market is, Greg? Some people come on and say it just looks stronger than it really is.
I think it's strong. I mean, it's defied all expectations. I think that is the punctuation of this cycle, that the labor market has exhibited so much more strength than I think anyone really forecasted. The ability of this economy to handle higher rates, the labor market handling higher rates. I think there's a lot of intrinsic inherent strength in this U.S. economy. And I think it's more on a secular basis than cyclical. There's going to be cyclical forces, of course, but, I think there's structural strength in the labor market. And what we're seeing across unions right now is emblematic of that.
Bob, what do you think about the labor market? I mean, everyone's got a list now of, bearish risks. We heard just now from Michael McKee, but you're also watching student loan payments, restarting the depletion of excess savings. That's one the Fed's been watching closely. The continued rise in mortgage rates and the slump in applications, delayed tax payments for California, Alabama, and Georgia, rising credit card delinquencies, and obviously oil prices. Is the labor market, as long as it's strong, do those things not matter as much?
Well, the labor market has held in very well until now. And then, as you said, there are these wall of things that have just lined up that didn't exist over the previous 9 months. And now the consumer is going to have to deal with that. There has been some slowdown in the labor market. We look at non-farm payrolls and we look at a 3-month moving average to smooth it out. A year ago, 450,000 jobs per month were added. 6 months ago, 300,000 jobs per month were added. Today, looking at the 3-month moving average, 150,000 jobs per month were added. So it is slowing down, and the consumer is getting tapped out. So I do worry.
Treasury bulls are getting louder and louder, Bob. I just read a story about AllianceBernstein saying they think we could see 2.5% on the 10-year within the next 12 months. What's your call?
Yeah, I think that the Fed is done hiking rates. I think the inflation we're seeing now is the kind that really slows down the economy. I am concerned as a holder of bonds. Certainly spiking oil prices and strikes are not the things that make for lower bond prices. But we go back to, if this is genuinely the Fed's last rate hike that we've seen, and they're not doing anymore. It doesn't matter if you have a soft landing or recession. The bond market rallies and outperforms cash meaningfully over the next 2 years. So I'll continue to hold bonds, although I'm a little bit more wary now.
Greg, what do you think? Are you wary, or do you back up the truck with, the 2-year at 5, the 5-year at 4.5, the 10-year at the highest level we've seen since 2007?
Well, I'm bullish on bonds, but for a very different reason. I don't think we want or need capital appreciation, right? I don't think we need a world where the 10-year is back to 2.5%. A lot has to go really wrong with the economy here, and so that's something I'm not wishing for. I think the bond market is back to its equilibrium, which is a roll and carry market. Getting the yield, getting the income, that is the value proposition for fixed income. It's not about this massive rally in the face of recession. So to me, I really do like bonds, high quality for sure, but it's about roll and carry. It's not about capital appreciation. And it's a very different backdrop as a consequence of that.
All right, great getting your take, both of you. Bob Michael there and Greg Peters, appreciate that panel. Coming up, the morning calls. And then later, Crossmark's Victoria Fernandez makes the case for a balanced portfolio amid a slowing economy. We'll see how slow she thinks it's going to get. That conversation still ahead. This is Bloomberg. This is the countdown to the open. I'm Matt Miller, in for my good buddy Jonathan Ferro. We are looking at equity index futures that are down now on the S&P and the NASDAQ. Russell 2000, little changed. I want to get right now to our morning calls. First up, Truist, upgrading Royal Caribbean to a buy, pointing to conservative earnings estimates and strengthening booking trends for the cruisers. Next up, JP Morgan downgrading Planet Fitness to a neutral, seeing limited upside after surprising changes to the C-suite of that gym operator. Finally, Evercore upgrading CVS to outperform, highlighting the stock's attractive valuation and improving operations. Coming up, trimming the leaders and buying the laggards. That's the call from Crossmark's Victoria Fernandez. That conversation up next at the opening bell. We could see drops on the major indexes, little move for small caps, but the big news, I think, is yields continue to march higher, as do prices for crude oil. This is Bloomberg. Good morning, good morning. This is the countdown to the open. I'm Matt Miller, in for John Ferro. Moments away from the start of trading, we can see that futures are down on the S&P, NASDAQ, and the Dow Jones Industrial Average. Trading starts in just 10 seconds time. There you hear the bell, and we're looking, by the way, at Instacart here, an IPO today. We're going to talk a lot about that throughout the day. I know that Ed Ludlow is going to focus on it in Bloomberg Tech. Let's take a look at some of the other price action that we're watching this morning. Euro-dollar trading at 106.90 right now. I think the 10-year yield is absolutely fascinating, right around 345, right around the highest level that we've seen since 2007. The same is true for the 2s and the 5s at 5 and 4.5 respectively. NYMEX crude up to $93 a barrel. That is not a Brent quote. Brent is up well over 95. So rising oil prices may be threatening the possibility of a soft landing for the Fed. In terms of stocks to watch at the open, one of them is Starbucks. You can tell I've had a lot of their product. The stock under pressure after TD Cowen downgraded shares to a market perform. The analyst writing, quote, "We see worrisome macro and competitive pressures that we expect to challenge China's same-store sales." Bloomberg's Abigail Doolittle has more. Abby?
How can we not start out our day with some Starbucks, Matt? But relative to this call, it's a very interesting one. So the stock is down nearly 2% as we do have TD Cowen cutting shares to an inline. So not a dramatically bearish call, but the reason behind it is China. Now, I do have a source who just recently returned from a trip from China, saying that the economy there is much worse than what is being reported on, and that the youth unemployment is much higher than expected. So that would confirm this call, along with various China bears talking about the backdrop there, especially around the property bubble and the credit crisis that seems to be unwinding. However, their business in August was very strong. It was up 48% in China on a year-over-year basis to nearly $1 billion. The company remains committed to opening 9,000 stores there by 2025. So you have this real divergence. It's also interesting that this analyst is making this call right ahead of the quarter ending. If he's an axe, it would suggest that he has channel checks that suggest that the business there has changed so dramatically. On the year, Matt, the stock right now is down close to 5% or so, down last year. If it stays down, and I know that we're only midway through the year, a little bit more than that, it would be the first double drop on an annual basis, going all the way back to 2007, 2008.
All right, we'll pay close attention to that. Abigail Doolittle, thanks very much for the update on Starbucks. Let's turn now to the IPO market. Instacart planning to sell shares for $30 or more as it makes its trading debut. Shonali Bassick has more on the story. Shonali, we're starting to get more of these IPOs, but they're like down rounds and worth a lot less than they were during the pandemic.
They sure are. At $9.9 billion, that's where you have Instacart valued into the pricing of its IPO. Remember, they upsized the IPO price here to $30 a share as the high end of the upsized range. So they did raise more money than what was initially expected. Let's put that $9.9 billion into perspective, as you've been saying. It is about a fourth of where it was valued at the pandemic, post-pandemic peak, when everyone was ordering online. But for the sake of its early investors, think Tiger Global, Co2, that have not had an exit in a very long time, or a significant one at this scale, if you will. You have Instacart now valued at that $9.9 billion, above that about $8 billion valuation it had in those earlier funding rounds when you saw Tiger and Co2 start to get in. Now, a significant amount of its shares are going to be placed into cornerstone investors' hands. That includes Dan Sundime's D1. It includes a division of Norges Bank. And by suppressing kind of the open demand outside of that, these IPOs have tended to get something of a significant pop, at least in this era, if you will, Matt. But remember, the Instacart IPO is facing a somewhat less buoyant market than what we saw last week for ARM. They did get that IPO pop. Klaviyo prices tonight, trades tomorrow. This is all ahead of that big Fed meeting, so let's see if they get what they want. Volatility is still fairly low, at least lower than what we've seen for the one-year mark at its high.
All right, Shonali, thanks very much. Our Wall Street reporter giving us the latest on that. Let's turn now to media. Disney is developing plans to expand investment in its Disney Parks, Experience, and Products segment to $60 billion in CapEx over the course of a 10-year period. Ed Ludlow has more on the Magic Kingdom. Ed?
Yeah, Matt, that would represent doubling CapEx commitments to theme parks, cruise lines, products and experiences. It's interesting to see some of the strategy playing out now that Bob Iger is settled back in as the returning CEO. Also, another piece of news breaking this Tuesday morning, ESPN and Disney Entertainment CFO Brian Castellani is leaving the company, the latest executive departure. He is heading on to take a role at Warner in their finance team. 24 hours ago, we reported, according to sources, that Disney's looking at what to do with its India assets, perhaps an outright sale of the Disney Star brand in that region, or a sort of combination piecemeal of some of the streaming rights for sports and Disney Hotstar, the regionalized streaming platform, or indeed a joint venture, as Bloomberg's reported in the past. So this CapEx global doubling to $60 billion is kind of the latest hint of the priorities for Bob Iger, but still lots of questions about some of the other media assets that Disney's been asked about in recent weeks.
I mean, such a fascinating story. We heard from Ken Griffin yesterday, I think on CNBC. He's like, I don't know why we're getting all of this negative press from Florida. And I also was doing the math, Ed. The last time I was at a Disney park, 1986. I was 12.
Well, I've only ever been to the Star Wars experience because, you know, I'm a big fan of lightsabers down in Southern California. But let's go on a little trip and check out.
Ed loves lightsabers.
Yeah.
I got it. All right, Ed, thanks very much for that. Let's turn to airlines. The sector tumbling into a bear market as the price of oil moves higher, obviously putting a lot of pressure on their bottom line. Lures investors away from the U.S. Global Jets ETF. It had hit an all-time low against the S&P. Simone Foxman has more on that story. Simone?
Yeah, Jets ETF hitting an all-time low against the S&P, but the index itself trading near its lowest since May. And Bloomberg Intelligence in a note today saying the negative technical signals could push the correlation between that ETF and the S&P even lower because its July peak failed to close above a January high. But stepping back, let's dive into some of the specifics that we're seeing amongst these airlines. Really, it's clear that the sheen of the summer travel season has worn off. Consumer demand may be flagging in the U.S. specifically, especially for domestic fares. We heard that from Spirit, how it's had to go out and discount a lot of flights. Airlines with international operations have been able to hold up a little bit better, but recently this rise in jet fuel costs has really hit them particularly hard, and that's where we've seen the biggest declines since hitting that peak back in July. Fuel costs cited by Delta, American, Spirit, Alaska, United, among others, reporting changes that could be material to their earnings, and that narrative definitely going to be in focus today as we watch Brent above $95 a barrel. Special mention today, we should also watch shares of United. They're trading slightly higher today, but it's the latest carrier to find bogus parts into aircraft engines. That's the result of some reporting from Bloomberg. Disclosed this news after hours yesterday, but it doesn't seem to be moving distinctly negatively today.
It's slightly terrifying, unless the parts are machined so well that no one can tell, and so they work perfectly, right?
Yeah, but it doesn't seem to be a safety issue, of course, at least not yet, and we haven't heard regulators come out and say that, but it is nonetheless concerning to think that bogus parts might be in your aircraft.
Absolutely. Simone, thanks very much. Simone Foxman covering that story for us. Let's get over to Crossmark's Victoria Fernandez, weighing in on the road ahead, writing, quote, "We continue to see many potential market-moving events in the wings. This is why we've been focused on a pullback in the final quarter of the year." I'm pleased to say Victoria joins us now with more. So you think we're going to see the market drop, what, in terms of the S&P by the end of 2023?
I do think we're going to see it, Matt. And you're right, there's all these elements that we see kind of on the sidelines that we're waiting to see them flow through the economy. So obviously the UAW strike, we're seeing that. And what is that going to do to wages across the board for labor? We've got a potential government shutdown. That can cause some volatility in the markets because it looks like it's going to go to a shutdown. It doesn't look like we're going to get an agreement anytime soon. We've got higher yields. You were talking about that earlier, and I think you're right. It's one of the most key issues that we can be looking at right now. And I think you're going to get rate cuts coming out of the market instead of having them priced into the market, which again is going to support higher yields. There's lots of elements that are going on right now that should cause some volatility in the markets. And we have seen, interestingly enough, Matt, that not just the Fed, but global central banks are all moving towards that higher for longer. That'll be supportive of higher yields, too.
And the question that that Ferro and Bramo have been debating on surveillance over the last couple of weeks is, do these higher oil prices signal stronger demand growth from an all's well American consumer, or is it just engineered by, you know, OPEC Plus and a threat really to the soft landing scenario? What do you think?
Yeah, I think it's really more of a supply issue at this point in time. I think if it was in the beginning of the summer when we first started to hear about some of these cuts, obviously there's more demand at that point in time for travel. But we are getting into the winter months, so you do have some increased demand in regards to heating that people need. So it could be a little bit of a combination, but I think supply is the driving force right now. We have a 95 handle on Brent today. That is going to continue to make that core inflation number sticky, and it leaves the Fed really with no choice but to either hike an additional 25 basis points in November or at least keep the level that they're at for a longer period of time. I think that's going to be the focus tomorrow at the meeting. People are going to be watching that dot at the end of next year. Where does that lie? I think it'll be higher than where it is right now.
Absolutely, that and the SEP. The question is, does the Fed watch credit spreads in the event of a downturn? And I actually have a viewer who writes in, a trader, Anthony Stefano of Cabrera Capital Markets. He wants to know, would a blowout above 800 basis points on the 5-year trigger Powell to think that they broke something? And I think, you know, the follow-on to that is, then will that amount to cuts in 2024? What do you think?
Yeah, I definitely think we're going to see cuts in 24, Matt. The question I think most people are grappling with is when are we going to start to see those cuts and by what magnitude? So I think it's going to be probably around the middle or the second half of next year before they start cutting. The Fed has taken a really long time to get where they are, and they have worked very hard to walk that tightrope to not lead into recession, even though I still think we're going to see a pullback. I don't think they're going to be quick to turn on a dime and say, hey, yeah, let's go ahead and start cutting rates and then add to inflation pressure as demand would continue to go up at that point in time. Credit spreads are important. You've got to watch them. Right now, they're still somewhat stable. The minute we see spreads start to widen out significantly, that's going to be a clue to the Fed that those tightening conditions have worked their way through the economy, and it's time for them to take a step back.
So what do you think of the Alliance Bernstein call today that the 10-year yield goes to 2.5%? Some people are saying back up the truck at these yields because you're going to see massive capital appreciation. Others, like Greg Peters, who we spoke to earlier, are going to say, regardless of that, this is a great return. What do you think of Treasuries?
Yeah, I think you need to have an allocation in your portfolio right now to treasuries, and we're actually doing it more on a barbell where we're taking that yield on the short end of the curve, taking advantage of that cash flow that you can have in your portfolio, but locking in some of the rates on the longer end of the curve. Look, 434, 435 is a very important technical level, and we keep bumping up against that yield on the 10-year Treasury. If we go above that and close above that, then I think you're looking more at a 450 level. But right now, the market seems to kind of keep that cap right there. If it does, and we get through this meeting and the November Fed meeting, then I think you might see yields start to come back down and you can have that capital appreciation. But either way, I would lock in some rates for cash flow.
Victoria, awesome to catch up with you. Thanks so much for joining us. Victoria Fernandez there from Crossmark. Coming up, GOP tensions looming over a potential government shutdown.
I don't think we should have a shutdown, but I agree with you that I think it is very likely. Joe Biden and Chuck Schumer both believe politically it is in their best interest to have a shutdown.
Inching closer to that as the UN General Assembly gets underway here in Manhattan. Team coverage up next. This is Bloomberg.
I don't think we should have a shutdown, but I agree with you that I think it is very likely. And I think the reason it is likely is I think Joe Biden and Chuck Schumer both believe politically it is in their best interest to have a shutdown because they believe that in a shutdown that the press will eagerly blame it on Republicans. And I think Biden and Schumer think they get a political benefit from it. And so I think their incentive is to try to force a shutdown.
Well, it's not just what Biden and Schumer think, it's what Kevin McCarthy actually said yesterday, that it would be in the administration's interest to have a shutdown. But Ted Cruz says the president also thinks so. Rising tensions on the Hill as Congress faces that looming deadline at the end of the month. House Speaker McCarthy's latest proposal to avert a shutdown is already facing stiff resistance from ultra-conservative members of his party. Here's what he had to say to reporters.
I've told all of Congress, you're not going to go home. We're going to continue to work through this. I'm not giving up on the American people. I'm trying to convey to my members, if we want to be able to win these objectives, we should show the American public our ideas and be able to pass them. Is it a struggle? Yes.
Let's bring in Bloomberg's Kayleigh Line. She is in Washington for more. Kayleigh, do Kevin McCarthy and Joe Biden agree on too many things for his base?
Well, that's a really interesting question, Matt, because, of course, should something like we saw in the debt ceiling happen, where Speaker McCarthy actually is able to broker a bipartisan compromise with Democrats, it could actually work against him if he wants to keep the speaker's gavel. That's when we could potentially see one of these members who have been railing against him actually file a motion to vacate and try to kick him out of the job. This is just one of the reasons why this is a very difficult situation for him to navigate. Him saying that it is a struggle almost is an understatement because, of course, there's more than a dozen members of his own party who have said they would not vote for the deal that was brokered between members of the House Freedom Caucus and the more moderate Main Street Caucus. That, of course, would include 8% cuts to domestic agencies in terms of spending also include many border measures, but a lot of those hardline conservatives would like to see it go further. They want deeper cuts. They also want to defund the federal investigations into former President Trump. They'd like to block spending of previous aid agreed to for Ukraine. All of those things would make it even more dead on arrival in the Democratic-controlled Senate and make it very unlikely that it would ever get a signature from President Joe Biden when it comes across his desk. So it goes to show you that this is not looking like it is bringing us any closer realistically to averting a shutdown. It is a very difficult needle to thread, but time is running out to get this thing sewn up. We're just about 12 days away now from that potential closure, Matt.
So is this dependent, Kayleigh, avoiding a shutdown on a continuing resolution, or is it possible that, the House gets all of their legislative work done in that time period?
They just really, realistically, Matt, do not have enough time. The House would need to pass 11 more appropriations bills. They've only done one so far, and there's only, I believe, 7 or so legislative days, at least, on the calendar between now and September 30th when that funding is running out. So a continuing resolution like the one on the table that would temporarily fund the government until October 31st looks like it's realistically the only way to avert a shutdown of the government.
All right, Kayleigh, thanks very much. That's an important look at the domestic issues we face. Let's look at the foreign affairs issues and get Midtown Manhattan congestion report. Global leaders gathering in New York City for the UN General Assembly. President Biden delivering his UN address at the top of the hour, just minutes from now at 10 a.m. Eastern. Bloomberg's Anne-Marie Horton joins us from the UN Rose Garden with a preview. AMH, what can we expect?
Well, we just got some excerpts for what to expect from the president when he gives this address at the UN. Matt, we should note he's the only leader of one of the permanent 5 countries on the Security Council to actually show up. The likes of Putin, Xi Jinping, Macron, Rishi Sunak, they are not here. And what the president is going to really use his address, as Jake Sullivan told reporters last week, is that a really big chunk of his address will be about Russia's invasion of Ukraine. So the president really has 2 audiences here. One is going to be the international community, the global South, that have been reluctant to really want to isolate Russia and ramp up punishments on Russia. And the other, of course, is going to be the domestic audience. If you look at polls, more voters have this fatigue when it comes to sending money and aid to Ukraine, especially Republican voters. And that is why what Kayleigh was talking about, it's been so difficult, not just to make sure the government keeps funding, but also potentially getting that Ukraine supplemental aid through Congress. What the president is going to say on Russia, Matt, is this. Russia believes that the world will grow weary and allow it to brutalize Ukraine without consequence. But I ask you this, if we abandon the core principles of the UN Charter to appease an aggressor, can any member state feel confident that they are protected? If we allow Ukraine to be carved up, is the independence of any nation secure? This is the kind of rhetoric you're going to be hearing from Joe Biden when he touches down here at the UN in just about 20 minutes' time.
All right, Anne-Marie, thanks very much for the update. Look forward to the headlines from the president. Now let's get back to the markets. We are looking for some sector price action this morning. In the 20 minutes we've been open, what have we got so far, Abigail Doolittle?
It's interesting, Matt. So we're looking at a very small decline for the S&P 500 of about 0.2%. But a couple of the heavyweight sectors are on bottom. Consumer discretionary down 1%. We also have tech down 0.4%. So let's see if the decline builds. Up top, though, energy, not surprisingly. Let's take a look at what's happened over the last 2 months, because you were talking about the airlines earlier and, of course, autos with the UAW strike. Both of these sectors since July down sharply. Airlines, as you were mentioning earlier, in a bear market. This as fuel costs simply continue to climb.
All right, that's what to watch. Markets been open for 22 minutes, but about to kick into high gear. Coming up, the events that you need to be watching out for this week. That's next in our trading diary. This is Bloomberg. This is Bloomberg's The Open. I'm Matt Miller in for Jonathan Ferro. Quick look at the markets, unchanged on the small caps, the NASDAQ and the S&P, both down right now. Let's get to today's trading diary. what you need to be watching all week. President Biden, as Anne-Marie just told us, speaking at the UN General Assembly in just about 15 minutes' time. Then tomorrow we get a Fed rate decision, and Chair Powell will give a news conference as well, the dots and the SEP. That's the big deal. Could be a hawkish pause that we're in line for. Then the BOE, the Bank of England, announcing its decision on Thursday. Plus, we'll get U.S. jobless claims and existing home sales. And finally, on Friday, a Bank of Japan rate decision. So a couple of other central banks than the Fed making announcements this week. This was the countdown to the Open. I'm Matt Miller in for Jonathan Ferro. Have a great Tuesday. This is Bloomberg.